Good morning, everyone. I'm Rick Bensignor, Chief Market Strategist at OptionsPlay, and welcome to this week's Global Technical Research Monday Morning Report, where we give you the outlook for the markets for the week and give you my thoughts across a variety of different key markets that I think will be important for you to have a handle on as we start the week off. It's not a good one. S&P futures down about 30 points or so as of right now. The Nikkei was up 1% overnight. Treasuries, our yields have fallen again right from resistance. We'll take a look at those charts at about 3.4% or so. I think crude oil is going to be the big story on the day. It is finally breaking down about $3.50 a barrel down to 101 and small change. Nat gas up about 40 cents. Bitcoin getting slammed today down $1,250. That's almost 6%. And a lot of this is because, once again, the dollar is flying. It's up almost an entire point today. Right now up about 90 bips at 107.99. So let's call that 108. And that is certainly the highest level it's been on in probably about 2 decades. Gold feeling pressure again from dollar strength, down almost $10. So that's how things start off. The overview for the week right in front of you, the S&P continues to hold above its important short-term support levels and intermediate support levels. So we'll take a look at that. U.S. 10-year rates, again, bounced last week from right near support. The low last week was 2.75. There's good support at 2.7. We said there was resistance at 309. That's where they stopped. And again, heading back down, potential trading range. The U.S. dollar has, again, made new highs. We just talked about that. And again, I think a lot of what's going to happen is going to be based upon how oil's trading now and the fact that oil is potentially getting an important breakdown right now that could lead to better stock gains and certainly more pain in the energy side of things. All right, let's widen out our view. And just give me a yes in the chat just to make sure this is all coming through fine and that you hear me. Cool. All righty. Great. All right. So let's get into the details of things here. I'm going to switch and push this off to the side, still keep it in front of you. But here, here is the weekly S&P chart. And of course, last week, we once again touched the downward falling conversion line. This kind of pink colored line has been resistance over the last few months. We topped against it about 6 weeks ago. We've touched it again and pulling back at least to start the week. So we do know that that is a fairly consistent resistance level, and bulls would need to see several Friday closes above this level in order to think things have really turned the corner. Secondary resistance purely from this chart is at 41.64. Although once we start trading today, that middle Bollinger Band, which is in light blue, is going to continue to fall. So that'll actually be lower than 41.64. But that's also the TDST line that we broke down from. Underneath us, it's important to stay above 36.96. That is the both daily and weekly bearish propulsion momentum level. Proper closes underneath that suggest a new move down that could go as low as, where is that, 34.46. That's down here. So at that point, if we broke there, I would expect new lows. If the 36.17 level breaks, which it probably would, so we either test the lows and it stops right there and turns around, or it starts a whole nother leg down to roughly 34.50. So when you look at where the S&P is, you're kind of halfway in between potential real support underneath the market and a potential downside target level and upside target level, which makes it that much more difficult to start putting on. Too many charts are up. That doesn't make sense. There should be one and only one chart. You shouldn't be able to see anything but this chart. So I don't know how there's too many charts. That doesn't make sense to me. This is my screen. Yeah. So that's kind of where potential stall against resistance and a pullback. Let's take a look at what the Qs are doing and see how they look relative to what the S&P looks like. And the Qs actually cleared their conversion line last Friday. So for the first time since, I guess, it's been here. I guess the last time we were above there was back here in very early spring. You'd, again, want to see multiple Friday closes above about 292 in order to think that this can stage a rally to then at least target what is now a declining baseline. Otherwise, this also would suggest that if we take out the 288 and a half-ish level, again, we either just simply touch a little beneath to hit the 200. This should be 200-week moving average, not 200-day, but it opens the door for a much bigger decline. So that's the way I see things. We're kind of in no man's land, but up against some resistance. And until the resistance doesn't act as resistance, I think you play it that way, certainly from a trading point of view. This has been a pretty strong decline since the beginning of the year. One breach of the conversion line to reach the baseline back in early spring, and then resistance against the conversion line since. So market is still heavy. I think the crude story, again, could help things out. And you've got CPI out later this week. People are going to focus on that and see if it's improved at all. If it starts heading towards 9 and 10%, then things are still pretty darn bad. And if you don't get at least some relief on the gas side, food prices, or it's just an indication of really high inflation and the problems that persist here. Let me pop up the report again. So we've done the S&P, we've done the Qs. Let's take a look at the Nikkei. And I understand that most of you are not trading the Nikkei, so I don't show you it. Let me see, do I have the chart up here of it? Yeah. But it's a good indication, again, as what has been another, in fact, the only major international stock index that hasn't broken its cloud, besides the S&P and the Dow on the weekly charts. Everything else has broken. So again, the cloud charts are a Japanese model. They very closely watch Ichimoku. So you had this very minor breach. We came back. Again, my guess, and the way I'm looking at things is, if we get a Friday close beneath this Friday close from 4 weeks ago at 25,930, this breaks to also test the lows, test its 200-week moving average, and it opens the door again for potentially a larger move to the downside, and that would just be another one of the stock indexes that has broken. If it holds itself in here, then it potentially, if you look at what happened, right, we get deep into the cloud. This is with a lagging line. It rallies against the top of the cloud. So this rally in here that also stalled against the bullish propulsion momentum level. In other words, if we had properly gotten above this, then it would suggest a further rally. It stalled right against what would have been a bullish breakout. At the same time that the lagging line hit the top of its cloud, we've been down since. We then go back revisit the bottom of the clouds, get this minor breach that next week comes right back up. If we take out that close, again, in this level, 25,930, it opens the door for a test to the lows. That's how I'm looking at things. Next, let's go back. So that's the Nikkei. Let's move to the fixed income market now and take a look what yields are telling us in the US side of things. And I've said to you before that I do believe that the pattern that got created in the US 10-year is, for the time being, the high that we're going to see in yields. And it's based on what I call market harmony, the fact that the potential top has been made the same way the bottom was, which if we go back to 3.25%, which was the last high that US 10-year rates made before collapsing down to all-time lows, there were two declines where we saw combo 13s. In yellow was the first decline. The second was the all-time low, and I've put that in this bright blue. On the way back up, first 13 came, minor pullback to the conversion line. Second one has been the top. And notice that on the move, that got us to 3.45%, which was the intra-week high. We closed just beneath 3.25%, this horizontal line that started this whole thing. We've pulled back, we've broken the conversion line, and the bearish propulsion level to the downside, suggesting next move down to about 2.7%. We got to 275. We now have resistance at 309, the conversion line, and we're staying beneath that. So it wouldn't surprise me if for the next few weeks, we kind of stay in a trading range somewhere roughly around 310 to the upside, 270 to the downside. If we break 270, then right now we would target 2.58. But in the bigger picture, the fact that we've stopped where we did, I think that there's a good chance that's the high. If we exceed the highs, look for a test of 383 or so, at the low 380s. That's the risk level from this 13. In other words, you have to properly hurdle this level. It's 3.81% in order to essentially stop out the concept that this is your exhaustive signal. So I'm playing for the fact that bonds are buyable for trades on rallies and yields. And again, we went from 275 to 309 last week. We've pulled back. We're still north of 3. We're at 3.03 right now, but I think we probably play in this trading range. And by the way, the inverted head and shoulders pattern that we have labeled here, and I'll just take the cloud charts away so you see it more easily. That measurement actually measured to 3.25%, where the whole down move started and where we've stalled. So this is a formal completed pattern and hit its target to the upside. Therefore, to me, we've done everything we need to, at least within the context of this move and bottoming pattern. We've hit our targets. We got our exhaustive signals. I'm thinking that, even though we know the Fed is raising rates, the market's been well ahead of that. And for the time being, that's how I'm going to play things, is that we're going to consolidate in here for some time. And notice that after we made the spike low in 2020, we spent certainly a full quarter just consolidating somewhere near there as you get the final sellers who just couldn't take it anymore, and sellers in yield terms, buyers of bonds, versus those who started accumulating, understanding that there's likelihood that rates were never going to go to 0% in the US. And you see a good double bottom here that spanned many months before we started working up. Multiple 9 counts caught, lots of interim moves, and so on. So my view is yields have most likely topped for this phase of the cycle. And you'd have to get above 381 to think that we're going well higher. Let's take a look at the TLT, which is how many people play the bond market. But just remember, I've said this to you before, but I'll say it again. The TLT is a proxy for the US 20-year bond, not the 10-year. If you want something that more closely matches what you see every day quoted on the news and TV as what the US 10-year is doing, trade IEF. That's the ETF that tracks the US 7 to 10-year maturity timeframe. That is the closest ETF that is going to most precisely match the TNX chart. So when we look at TLT, now TLT has more liquidity and more volume, but IEF is going to be a better match. Notice the same concept that we went and tested the lowest low. Essentially, when bond yields had hit 3.25, that's this low in here in 2018, and we've come and played with it, and we're holding above it. And I give it room down to about, I'd say 108.18. I'm not sure I'd want to go down to that's 106 and change. But if you're looking to potentially use rally in rates to buy bonds as trades, I'd say anywhere from current price down to about 108.81 is the level that I think you kind of use to play for a move. Now, TLT needs to get above 119.42 to get a breakout to the upside, which then could target almost 131. I wouldn't expect it to get much beyond that because you're going to have longer term resistance in place. But that's the way I think the bond market is going right now. And even if you bought it down at 110 and it got to 119 and change, still not a bad trade. That's TLT. Let's take a look at, I think what I have next, or if I remember, credit spreads. So here I'm going to show it to you directly from our report. Let's just make this a little bigger. So this is my preferred credit spread. Again, what's a credit spread? In this case, what we're looking at are an index that the Federal Reserve monitors of the ICE Bank of America Corporate Bond Index spread. This is BBB rated corporate bonds, BBB rated or better, so investment grade quality bonds, not junk, versus a comparable maturity U.S. Treasury. So when this moves higher, it means that investors are demanding more yield in order to hold a corporate bond, and a quality corporate bond, as compared to a treasury. Wider yields mean widening spreads, mean they have less confidence in the economy and the stock market. And we have played this very well this year. I had on the institutional side, we bought the breakout here above 1.04%. We kicked it out just beneath this green line. We got back in right on the low, kicked it out right near the green line again, and then bought the breakout above 1.54 recently. It has gotten as high as 1.67%, pulled back a little bit last week as whether it's because the market saw some strength or the other way around, or the market saw some strength because the spread came in a bit. Either way, this measures up to no less than 1.8%. And I'm coming up with that by taking the lowest low, measuring the move to the high, the first high off of there, and taking that same distance off of the interim low. So what I call equal legs. Up move, pull back, up move measures to 1.8%. So I mentioned this to you last week. I've got my institutional clients into this widening spread. We got it at 1.5%. Again, recently looking for 1.8, and I've moved my stop up to 1.5, so I don't need to risk much on this. But I suspect that even if we get a little pullback, we closed at let me think, where was it? 164, I think we closed it's 1.6%. So I still have 10 bips to play with here as far as cushion. Stop out at break even, play for 1.8%. More importantly for you, instead of necessarily trading this, is to understand what this implies, and that you've got this now. This is not a real-time chart in the sense that we're looking at the report I prepared for the week, but just to put this in context, in March 2020, when we had the bottom of the sell-off, when COVID first sent the market into a tailspin, this spread had widened out to 4.01%. It then collapsed to 0.86%, which it double bottomed on and then started moving higher. So there is plenty of room for this to run higher to get anything remotely close to where the March 2020 low was. And I'm not saying there's a reason that, based upon the economy, that we should get anything close to where that spread widened out to. But even if we got to half of that, it's 2%. It's still well above where we're trading now. And to me, looks like we've got a good bottom in place. And this, it may zigzag up, but it still suggests that credit spreads should widen. And if credit spreads are going to widen, it is certainly going to cap how much stocks can rally. So it doesn't mean stocks can't rally at all. It just means that the credit markets are concerned and that investors are demanding more money to take the risk of holding quality corporate bonds than they are for treasuries. And that's a negative implication about the economy and typically the future direction of stocks. I'm going to answer this question only because it specifically pertains to what we're talking about, but what is the symbol of the FRED? The FRED is the Federal Reserve. This is here. If you look at the bottom here, where I indicate this. So if you go to the Federal Reserve of St. Louis website, which is, you'll see here, https://fred.stlouisfed.org, and put in the string that you have in front of you on your own copy of this, or just take a look at what it is here. That is the symbol. So you can go to this same website and get this information like I do every day. It updates once a day with the prior day's closing price. There is a 1-day lag from today is going to give us Friday's price. So there is a 1-day lag. This is not real time. The only way I know of getting real time is through a Bloomberg, if you subscribe to it, but otherwise for the public, there's a 1-day lag in this. So just realize that, last week when it closed at 1.6, that's Thursday's price. That's the most recent data I have when I put this report together over the weekend to provide you with. Which ETFs mirror this would be, and I'll repeat what I've said before, but I know that we get new listeners each week. The best way to play this is buy the Treasury. So the 10-year Treasury would be IEF, India Edward Frank, and you would short either one of two BBB corporate bond spread ETFs against it, either LQD, Larry, Queen David, or Apple George, AGG. Those are the two most commonly traded BBB bond ETFs. So you could pair those up against each other, look at which one has the weaker chart between AGG and LQD, because the weaker chart's the one you probably want to short between those two. And you'd buy, again, treasuries against it through IEF. Okay, crypto and dollar. Let's take a look at a long-term dollar chart. Now, again, I have not partaken with personally or with my clients in most of this year's rally. Several months ago, I had a 9 count against prior highs. I knew that a little bit above was the propulsion level, the exhaustion level. We've now even hurdled that. And now we're very quickly approaching the stop out from that 13. To me, that all that simply did was stop me from actually playing the dollar as a trade. But what I've done all along is incorporated the fact that we have a rallying dollar into the overall macro analysis that I have. And of course, a strong dollar has been a problem for the stock market. And remember, stocks had a year last year that never saw any major pullback, and it's because we were still kind of within the tail end, but the midst of a decline in the dollar. And certainly if you look at this year, as the dollar has rallied, stocks have fallen. So the more we see a dollar on a breakout, and we're getting, when we look at long-term horizontal breakouts, it's creating another leg higher, suggesting that we could potentially get and test the all-time highs all the way up here at, where is that? 120-ish, give or take. So there is importance in understanding that this dollar move continues to be certainly a problem for gold and the obvious things. It continues to be a drag on corporate profits from companies that have U.S. companies that have large international profit centers. The profits get reduced because those profit centers report in local currencies, and if the dollar's stronger, those reports end up showing weaker earnings than they would have been if you had a flat dollar or a weak dollar. So it affects corporate profits on multinationals. It certainly affects the metals markets. And we're seeing that there is some correlation recently to the direction in general of the stock market of a strengthening dollar has not helped whatsoever to stocks. So we may see crude oil come off and we say, that's good, that's reduced inflation. But if the dollar keeps surging like this, a lot of it's going to be offset to the typical portfolio manager's way of looking at what's going on. So this, these moves and this a 12-month plus move in the dollar since it bottomed back in, what is that, May of 2020, or I'm sorry, May of 2021. So we have over, a 1-year move. That if you think about where NASDAQ stocks topped in late winter, early spring 2021, it's the same time that the dollar bottomed. Now, it doesn't always work that way, that there's an inverse correlation, but we are in a phase that is what is happening. So seeing the dollar move up a full point today is another drag on the market. And part of the reason, let me see, S&Ps are right now down about 27. It's part of the reason we start off with a negative day. Okay, let's take a look at dear old Bitcoin, which no matter what I would say about it, you guys are going to want to trade anyway. Here's the long-term Bitcoin chart. It's a weekly chart going back several years. And of note in recent times is that several weeks ago, we have both an aggressive combo and a standard sequential downside exhaustion signal, which could give you a reason to be a buyer. here's my issue, and it doesn't mean you can't buy and that this might not work, but here's what you need to look at in the context of everything. The stop out from the 13 is down at 15.5. The real stronger support comes between 11,400 and about 10,550. That's where this whole breakout move started a few years ago. And if I measure the all-time high down to this low here, the major low it made, and then take that same distance off of the high, in other words, again, equal legs down, that measures to 11,400. There's a TDST line here at 10,550. They're unrelated to each other, but we have two significant downside targets, roughly in round numbers, $10,000 lower. That's how much you have to risk if you buy down here. On the upside, if you buy and it works, there should be very substantial resistance either side of 30,000, where the trend line broke, where all these horizontal lows broke, where you have a head and shoulder pattern neckline that broke. So you kind of at a 50-year right in the middle, near 20,000, 10,000 to the, you got 10,000 risk to the downside, 10,000 to your target on the upside. Hard to make a case for why this is going to substantially move above 30,000, given this topping pattern and the amount of people who are long higher who are stuck. So if you're going to play this, just understand where we are in the context of support and resistance that are meaningful. If I had to choose one way or the other, I'd probably give a little more advantage to the fact that, we have some downside signals. Let me take a look at, okay, so on this weekly chart, you'd have to get above 29,000 to get a bullish breakout. That's not likely happening. So that's another reason why buying it has tremendous risk here of 50% risk for 50% reward. That's a darn tough thing to play. And if you measure the head and shoulders top, and right, so if somewhere around 30,000 is the neckline, and the all-time high is just shy of 70,000, was 68 and change, 69 and change. So it's almost $40,000. So if you took $40,000 away from 30,000, you have, this projects to negative price, right? So there's a heck of a lot of reasons why it's just not a great idea. And you're going to do what you're going to do, and you're going to play the way you play. I'm just trying to give you as objective a view as I can give you on your risk versus the reward of getting into Bitcoin. Okay. Commodities. Let's take a look at oil, because as I've said, I do think oil is going to be an important factor this week. And it's copper, not oil. Here's oil. So we've talked about this, but I want to show you. Look at this horizontal orange line. This is the baseline from the cloud, right? It's the calculation is it's the midpoint of the last 26 bars range. It'll find the lowest low and the highest high in the last 26 bars each week and calculate the midpoint. And the reason why it's moved up recently is because we're dumping out lower numbers here. So it's taking the high versus a higher low, therefore raising the midpoint. Even with last week's big spike down to the prior lows from this year, by the end of the week, we closed just above that 104.17 level and managed to hold on to the baseline. That was good. If you're thinking of this in terms of bullish or bearish, it's crude oil, it was at least not bearish. And given that multiple times, it had held 1, 2, 3, 4, almost 5, 6, almost 7, 8 times it either traded the baseline or got close to it. That was significant to come all the way back to hold it. But on the flip side, the last 1, 2, 3 weeks, the conversion line was where the highs were. So now these two are coming together. We need to really pay attention to which direction this breaks in real way. This week, today is Monday, makes it look like this is potentially going to break to the downside. And if we close beneath both the conversion and the baselines, that would be the first time we've done that basically since the start of the move up in January. So that is potentially significant. What else is significant? We have a 13 on the top of the move, not the highest high for the year, but the secondary test. We're in a 5 count down this week. We're potentially breaking both conversion and baselines. Now you'll see there is a trend line that this is still holding on to, but this potentially becomes a catalyst that we get weaker oil prices. If we do, again, the average investor is going to take a look at that as some relief for what's been going on, a reduced inflationary type pressure, and that is potentially good for stocks. Now, I can also make this into what looks like a pretty decent trading range between this horizontal purple line I just put out here and all these bottoms that we've seen. So it's also possible that we're just end up going sideways for a few more months over the summer until the cloud comes into play. Don't know. But if we close beneath both the trend line and the conversion baselines this week, then I have to give the edge to the fact that there's a potential downward bias here for oil. So that's the way I'm looking at things. And of course, the implications for all that. And then let's take a look at gold. Gold continues to have significant problems, mostly because of dollar strength. So we're seeing gold last week was closed beneath the bottom weekly Bollinger Band. It has broken a several-year uptrend line. There's another uptrend line that's coming into play a little lower, which looks like we may end up testing. Now we have, look at the orange horizontal line near 1675. Look how many lows we have. So this also kind of has a big trading range from the horizontal purple line, give or take. There's no one exact level, and down to here. So if I take the Bollinger Bands away and we look at this kind of more horizontally, we can say, besides the all-time highs since then, we have this zone in here that caught all the highs, and we may very well come down a little more to start playing with all these lows. Gold is in trouble, and it's been continuously in trouble simply because the dollar moves up. Gold is priced in dollars, so as dollars become more expensive, the value to owning gold decreases. That's your story on gold. And I think that may be it besides earnings. Copper. Let's just quickly take a look at copper. So copper finally broke a couple weeks ago. Not only has price broken through the clouds 5 weeks ago, but finally the lagging line broke through too a couple of Fridays ago. Last week we had a spike bottom. This continues to be under pressure. Looks like this could target as low as 303, but we have to still, in the near term, look at this spike bottom and see whether or not that gets taken out. At this point, first resistance is up here. You may not trade copper, but if you trade Freeport Mac or any of the other copper-related stocks, it's important to know what the actual commodity is doing. Okay, and I think that's probably it. Yep, let's take a look at the relative rotation graph. We'll take a look at earnings, and I'll quickly get through a couple of questions. So we're continuing to see energy weakening. Utilities, of course, these have all crossed. The only thing that's still up in here is healthcare. It's even, well, it may get a bounce here. It looks like it got a little pop, but we're seeing a lot of the cyclical stuff come down and the defensive stuff weaken. And you're starting to see improving technology. Even XLC, communication services, is starting, it may finally be breaking out from what had been sitting here forever. Financials still in the worst category, as are consumer discretionary. And earnings, I've highlighted the really important ones for the week. Delta on Wednesday, Taiwan Semi, probably the most important name in the chip space. And then, we kick off with financials. So JP Morgan, Morgan Stanley, and so Star Cummings, Citigroup on Friday, and United Health. Those are the ones. All right, that's this week's report. Let me get to a couple of your questions. Just if you're deeply involved in listening to me, the market opens in 5 minutes, so you may want to go ahead and let's see, Rick, you don't show those trades on OptionsPlay. Where can you get those particular trades with credit spreads? The credit spreads we talked about, in my own website for individual investors, which is inthenotrader.com. That is a trade that we have on and we've played before. So it's putting pair trades on with options is there's to me there isn't a great way to do that, and that's why they're not in OptionsPlay. Outrights, obviously, directional trades you do, but pair trades don't translate well with options. Rick, would you play TLT through a debit call spread or outright put spread? Down here, we're close to support. You could do it either way. I don't know. I might do it through the selling the put, and collect. In this case, collect versus paying, because if we go sideways like bonds did when they bottomed and went sideways for months, buying the call spread, and if we get into a trading range, the call spread will just wither with time. So if time becomes a factor on this, which it may well do, I rather collect time premium by shorting the put spread. I already answered the Fred thing. I answered that. Never traded Bitcoin. Why does US dollar continue to climb? I think a lot of it is just the safety issue that the US presents relative to other places in the world. Europe has its own problems. Their energy prices are going through the roof in Europe. Several economies are not very good, and they're certainly more affected by the Ukraine war than the US is. And so their currencies aren't doing well, and people naturally go to the US dollar as kind of a safe haven. The report, good morning, Rick. Please remind me where we can find the report I'm referencing. Well, it's either, I'm not sure which report, but it's either the options report, which you would have gotten this morning before the show, or as a subscriber to In the Know Trader, which is my own company that I've had, for years, that I have my, subscribers to that. Are you still long UNG, and is this a good level to add? I am personally still long UNG, and the No Trader clients are still long UNG, and I think it was 2 weeks ago we added more. Is there a list of the indicators that Rick uses for his charts? Yes. In our, let me see, do I still have it here at the back? Yeah. If you just scroll farther, you will see I explain the 9 and 13 counts. I explain Ichimoku. So yeah, there's TD combo, propulsion, trend factors, things that I use. I put right in every report. Boom mic is great, good. Glad that's working well. What is the play for earnings on JP Morgan? I don't know. I haven't looked close enough to know. When you say credit spreads have widened referring to the BOH, what does that mean? Well, you've answered that. I have a problem playing credit spreads. TD doesn't let me sell short the bond ETF. Find a different brokerage account. If Ameritrade doesn't let you short any ETF, find a place that will. Those are liquid ETFs. There's no reason that you shouldn't be able to short them. That's it. All right, folks. We went through all the questions, and it's 9:30. Market just opened. I hope this was valuable. And let's see. I don't think I have anything else with you guys this week other than daily plays, which we come out with. So have a good week trading, and I'll see you next Monday. Bye-bye.